And gentlemen, good day and welcome to the Q1 FY2024 earnings conference call of Gati Ltd hosted by Prabhudas Leeladhar. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectation of the company as on the date of this call. These statements do not guarantee the future performance of the company and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Praveen Sahai from Prabhudas Leeladhar. Thank you and over to you, sir.
Thank you, Carol. Good afternoon, everyone. On behalf of Prabhudas Leeladhar, I welcome you all to Gati Ltd Q1 FY24 earnings conference call. Today, we have with us senior management team of Gati, represented by Mr. Firoza Sarkari, Managing Director and CEO, and Mr. Anish Mathew, Chief Financial Officer. I will hand over the floor to the management for their opening remark, post which we open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Praveen. Good afternoon and a very warm welcome to everyone on our Q1 FY24 earnings conference call. We have uploaded our results and earnings presentation on the stock exchanges and company's website, and I hope everyone had an opportunity to go through the same. As mentioned, along with me, I have Mr. Anish Mathew, the Chief Financial Officer of Gati, and our investor relations team. I will now share an overview of the economy, industry and business, after which we'll hand over the call to Anish to discuss the financial performance of the company for the quarter ended June 2023. The global economy. World economy is in a state of stagnation. As per the International Monetary Fund, global economic growth is projected to decline from 3.5% in 2022 to 3% in 2023-24. This projected growth is below the average growth registered during the past 2 decades before the pandemic. The sluggish growth in global economy is projected on account of multiple factors like high inflation, Russia-Ukraine conflict, and sluggish demand recovery post-COVID-19. Policymakers around the globe are facing a tough task of fighting inflation, maintaining financial stability, and supporting economic growth. On the positive front, inflationary pressures are expected to ease out in the second half of 2023, and the global economy is expected to gain some momentum in 2024. The growth momentum is expected to come on the back of robust household spending in the United States and European Union, and along with recovery in China following reopening of its market. Indian economy and logistics sector. Amidst an uncertain global economic outlook, Asia Pacific is poised to show some green shoots amongst the major regions. The growth in this region is expected to be driven by India and China. The IMF has projected Indian economy to grow at 6.1% in 2023. The growth outlook for India is based on decline in inflation and thrust in investments by the government, which will lead to job creation, income and increased demand. The e-way bill volumes for June 2023 stood at 8.61 crore as compared to 7.45 crore in June 2022, showcasing a growth of 15.6%. This signifies resilient domestic trade and transportation activity. Additionally, GST collection in June 2023 stood at rupees 1.6 lakh crore, up 11.7% year-on-year. Increased GST collection is indicative of momentum in the underlying economy. As India aspires to be amongst the top 3 global economies, the Indian logistics sector is poised to gain from it. With right government policies, thrust on manufacturing, and infrastructure capex, the logistics sector is bound to grow. A point worth noting is that India's road network has expanded to above 6 million kilometers. The growth of small and medium enterprises and increasing need for timely delivery of goods augurs well for the express delivery business in the country. Key trends that will shape up the logistics industry going forward will be digitalization, data-driven decision-making, rise of cross-border e-commerce, growth of direct-to-customers, especially in Tier 2, Tier 3, and Tier 4 cities, and the corresponding need for warehousing. On the company front, I would like to start by sharing few key updates on the company. Post all cargo acquisition of the KWE stake, the subsidiary holding Express business is now renamed as Gati Express and Supply Chain Private Limited from earlier Gati KWE. We have appointed Mr. Rajesh Gaurinath as Vice President Sales to accelerate profitable growth. Rajesh comes with 20+ years of experience in logistics companies such as DHL and Blue Dart. We have also signed an LOI with one of the largest domestic IT companies to build best-in-class Gati Enterprise Management System, renaming it to GEMS 2.0. This will be built on a microservices platform. Our express business continues to deliver a resilient performance driven by positive momentum in volume. Q1 FY24 volumes were up 5% year-on-year despite a strong base quarter. The base quarter, Q1 FY23, benefited from exceptional volumes driven by industry consolidation that favored a few players. We expect the positive sales momentum to continue in the coming months and to augment our infrastructure build-up efforts. Gati will now be launching the Bangalore hub in the week of 15th of August. For the first quarter of financial year 2024, the express business has recorded a revenue of rupees 367 crores. The gross margin stood at 27% and EBITDA margin stood at 5%. In our presentation this time, we have shared the service parameters. I will take few minutes to walk you through these. We have shared 3 service parameters. The first one being DIFOT, which stands for Delivery in Full and On Time. This parameter is an indicator of the successful point-to-point delivery, right from pickup to line haul to end delivery to the customer's customer. 2. TIFOT, which is Pickup in Full and On Time. This parameter measures the efficiency with which parcels are picked up for further transportation. And finally, the delivery efficiency, which is DE. Delivery efficiency measures last mile delivery service. One point to note in delivery efficiency is that in some cases it has customer dependency, which means that the delivery to a particular customer happens as per the availability and the choice of the customer. So these are the 3 new parameters that we have introduced. I would now like to share updates on initiatives undertaken under each of our pillars of growth. Sales acceleration being the first one. Our sales acceleration initiatives are showing positive results, which is evident from the increase in our volumes. At Gati, our primary focus remains on customer centricity and delivering top quality service. This approach has resulted in an increase in the wallet share from our existing customers and has also helped us sign new clients. We also see promising growth prospects by capitalizing on the synergy between the contract logistics arm of All Cargo and cross-selling across our EQ customer base. This strategic approach is expected to unlock new avenues for business expansion. Infrastructure development. At Gati, building the right infrastructure is of utmost importance. As mentioned earlier, we will be inaugurating our Bangalore Super Hub in the week of the 15th of August. This is another important milestone after the launch of Bhiwandi and Farrukhnagar hubs. These well-established hubs are equipped with cross-docking facilities and advanced material handling equipment, ensuring smooth and seamless operation. These initiatives have resulted in efficient loading and unloading, a reduction in turnaround time of the trucks, and created capacity to handle increased volumes. On the operations front, we have been making continuous efforts to enhance our operations. The focus is on increasing visibility for customers and optimizing productivity. As part of this endeavor, we have mandated GPS tracking in all our line haul and feeder vehicles, enabling us to monitor their movement in real time. Additionally, to ensure cost optimization and faster turnaround, we have embarked on route optimization exercise. Today, we can proudly say that all our service parameters are amongst the best in the industry. I would also like to highlight that we have started a nationwide training program for our Gati associates to create their image as brand ambassadors of the company. The Gati associates help us in our first mile pickups and last mile delivery. On the technology front, after successful and smooth deployment of e-docket in the retail business, we initiated the pilot for MSME vertical. E-dockets enable enhanced visibility, transparency, and improved compliance. And finally, on the ESG front, we also remain committed to our ESG journey and aim to convert our entire delivery fleet to alternate fuel vehicles by 2025. With this, I would like to hand over the call to Mr. Anish Mathew, our CFO, for financial highlights for quarter ending June 2023. Over to you, Anish.
Thank you, Phil. Good afternoon, everyone, and a very warm welcome to our Q1 FY2024 earnings call. I'll take you through the highlights of financial results for the quarter. I would like to start with the highlights of our express business. Based on your request and in line with the best practices, we have started disclosing our monthly volumes and also the service parameters. Volume performance during the quarter was encouraging and expected to build the momentum. The company saw pickup in orders from large customers as preparations for the upcoming festive season gathered pace. Total tonnage handled for Q1 FY24 stood at 292,390 metric tons as compared to 278,748 metric tons for Q1 FY23, reporting a year-on-year growth of 5%. A revenue from express business stood at INR 367 crores in Q1 FY24 as compared to rupees 365 crores in Q1 FY23. Corresponding gross margin for Q1 FY24 stood at 27.3% as compared to 27.9% for Q1 FY23. Express business EBITDA for the quarter stood at rupees 18 crores as compared to rupees 19 crores during Q1 FY23. I would like to highlight here that depreciation on ROU assets for Q1 FY24 was rupees 12 crores and interest expense on lease obligation was 4.4 crores. Our client mix for the quarter for KEA, SME and retail stood at 63%, 19% and 18% respectively. On a consolidated basis, Gati reported revenue of rupees 426 crores in Q1 FY24 as against rupees 431 crores in Q1 FY23. Reported EBITDA, excluding other income, stood at rupees 17 crores for the quarter ended June 23, as against rupees 19 crores for the same quarter previous year. We remain confident on the growth prospects of Gati and are dedicated to improving efficiency across the value chain. As mentioned earlier, we have been consistently providing other key comparative financial performance indicators in our investor presentation. One can refer that for more details. With this, I would like to open the floor for question and answers.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star then 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amit Dixit from ICICI Securities. Please go ahead.
Yeah, hi. Good afternoon, everyone, and thanks for the opportunity. I have a couple of questions. The first one is on your net realization in this quarter. If I look at the net realization, it is down, slightly down QOQ. We were of the impression that the letters for price hike have all gone to the customers. So just wanted to understand the acceptance of this price hike and if there is a one-off in the net realization that we are missing out.
So the letters for rate hike had gone out in the last quarter of last year itself. Like I had said in my last call also, while on the retail business, we have seen increase, but on the key accounts, generally they would only negotiate a rate hike when the contract comes up for renewal. Having said that, the net realization also is a combination of various other factors. Number one being the lane mix. So it also depends on if your lane mix shifts, which means if you're doing larger or longer lanes, your net realization is higher than if you're doing shorter lanes. It also depends similarly on the product mix. So in Gati, we also have products which are national products, zonal product, and local product. So it is a combination of all these that kind of brings our net realization. Having said that, we found that if we have to grow the larger customers, yes, we have seen a net realization fall in this quarter. We are cognizant of that, but a combination of these lane realizations would get our gross margin also equally supported, because our cost would also reduce if the lanes that are given to us are shorter.
Okay. The second question is essentially on the EBITDA margin front. So, in Q4, or it was Q3 FY23, you guided that by end of Q2 FY24, we should be reaching 9% EBITDA margin. Considering the performance in Q1 FY24, it looks unlikely, at least to me, that we would get to a number even closer to that by end of Q2 FY24. So, and since most of the super hubs are now operational, Bangalore super hub will get operational in August 15. So what kind of levers we have to ensure that EBITDA margin grows from here, and what would be the trajectory that we can look at?
So we still maintain that in 3 years we will be a 3,000 crore organization with an EBITDA margin anywhere between 10 to 12%. We don't move away from that. We will be showing improvement quarter over quarter to reach that figure. Every new hub that we bring in, of course, brings in a lot more efficiency into our operations, and therefore optimization of cost benefits do come in. So we will see as we move forward our cost optimization kick in. But to get to the margin figure, the one big factor for our margin would be the leveraging of our fixed costs by volume growth. And as we grow the volume, we will be able to leverage that and come to the figure of 10 to 12%, which we have maintained by 3 years when we get 3,000 crores.
Just to follow up on this, actually, our super hubs, if I look at it, only 3 are remaining: Indore, Hyderabad, and Kochi. And the rest, Farrukhnagar, Nagpur, Mumbai, Guwahati, everything is operational now. So I just wanted to understand that when we are saying that 9% we will reach in Q2 FY24, that was the understanding at least I had. So are we advancing this guidance slightly, or are we postponing this guidance slightly? 9% in near term?
Last quarter and this quarter, both the quarters I have maintained that we are not changing our 3,000 crore guidance, and we are not changing our 10 to 12% EBITDA guidance of reaching 3,000 crores by 2026.
Okay, sure. Got it, sir. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Rajat Sethia from iThought PMS. Please go ahead.
Hi, thanks for the opportunity. Am I audible?
Yes.
Okay, thank you, sir. One question about the business mix that we have. So what really is the difference between retail and MSME client, and what is the difference in their margin profile?
So the difference between retail and MSME customers, the main difference is that we do not give credit to the retail customers. The MSME customers get credit from us anywhere between 15 to 30 days. From a shipping profile, the MSME customer may be slightly more regular than the retail customer. From a yield profile, the difference between an MSME customer and a retail customer would be anywhere between 20 to 25%.
Okay. And in terms of their, the kind of business that they give, how are we differentiating, between a retail and an MSME? What's the difference in their profile, who are they?
So generally, retail customers are ones who come in clusters. So, for example, you have the cashew nut cluster, the sari cluster. These are small enterprises which work in clusters, and they are identified as the retail customers. The MSME customers are those who are actually manufacturing in a small way to supply to a larger manufacturing unit. They are spares or they are components. These are more in the industrial parks like the MIDCs or GIDCs, etc. So that is how the differentiation comes.
Okay, all right, sir. And what will be our annual maintenance capex?
Maintenance capex. What is the meaning?
Anish, you want to? So can you explain actually what you mean by maintenance?
Any capex that we need to do to maintain our facilities. So we see a number in our P&L which says depreciation of so and so. Now this depreciation is not really a cash number, right? So how much of this depreciation basically we need to replenish back into the business to ensure our smooth operations, whatever assets that we have on lease, how much of that depreciation is going back in terms of maintenance capital expenditure?
So the normal capex spend for us, would be in the range of around, 15 crore rupees. Okay, so, and that would include actually maybe 4 to 5 crore rupees of normal maintenance expenditure for our warehouses and STCs, and remaining actually would be, for our infrastructure, IT infrastructure. So unless until we do have a major STCs, we don't encourage a huge expenditure. And as we've been kind of explaining at, the previous calls, for any new STCs, we don't do the construction, that's kind of hand over to the landlord, and then we kind of take rental. Minimum expenditure which we incur as and capex would be in the range of around 2.5 to max 4 crore rupees. But otherwise, maintenance capex is very...
Okay. And this number that you explained, 5-6 crores, is it expense through P&L or this sits in the balance sheet?
No, what I'm referring to is capex spend, so which would be, pure capex cash outflow, which will be kind of, being charged to the P&L by way of depreciation. Actually.
Understood. Yeah, that's exactly what I was asking. Thank you. One more question. What exactly is how delivery efficiency is different from DIFOT? What does it capture? I think I couldn't understand that.
Okay. So DIFOT is basically a parameter to measure end-to-end service. That means if you are a customer and I tell you that I can move your shipment if I pick up from Bombay to Delhi in 3 days, that means from the time I pick up to the time I deliver, your time in transit will be 3 days. That is what is DIFOT. Delivery efficiency means that from the time it reaches my last operating unit in Delhi, from there to the customer, that is measured as delivery efficiency.
And it largely captures the time it takes versus the promised time from that particular point.
So delivery efficiency is a measure of same-day delivery, which means the day it reaches the last OU of delivery, it should get delivered on that same day as long as it reaches within a certain cutoff that is defined at each of the last OU. For example, in a certain operating unit, the cutoff would be that any shipment which reaches before 12 o'clock in the afternoon will get delivered the same day. In others, it could be 11 o'clock, in some it could be 3 o'clock, depending on where the last operating unit is. But this is clearly defined in the system, and we measure that so that when a shipment reaches before that time, it should get delivered on that same day.
Okay, all right. And how do we adjust the customer dependency that we have that you explained? Because some of the customers, may use their availability and all. So how do we adjust that into this?
So if you look at my target, which we have put in the presentation on delivery efficiency, we have mentioned a number of 93% over there, and that is because generally delivery efficiency should be 100%, but because of this way of doing business of appointment delivery, where the customer says, hey, don't deliver today, deliver tomorrow, or deliver after a couple of days. Even the target has been adjusted according to the historic data that we have in our system. So there are customers in India who would not want delivery on the same day but would want it after a few days. It all depends on if their inventory is choked in their own offices so that they don't have place to receive it. But this is approximately, as industry-wide, it is approximately 5 to 7%.
Okay, understood. And the other targets that we have mentioned, like DIFOT 90%. So this number, basically, how do you look at it? I mean, is this the first set of targets that we have set for ourselves and we are obviously hitting it now? Will that increase in future, this target, or do you think this is the industry parameter where if you reach, then that's good enough?
No, they will increase. If nothing, we don't stop at anything, right? So we have to, if we have achieved 90, our next target will go up. But we set our targets annually. So we make sure that one is to reach the target, but second is to maintain consistency, because consistency is very important in our business.
Right. And one last one. In terms of average weight that we, not average, actually the range, what's the maximum weight that we carry in our express surface logistics operations?
So on a per shipment basis, there is no maximum weight. You could give me 3 tons, 4 tons, 5 tons. But on a per piece basis in Gati, we don't carry more than 700 kg. You follow the difference between per shipment and per piece? Per shipment would be having more than one piece in it. So I'll tell you in normal parlance, box. So a shipment could be 5 boxes, right? So your 5 boxes that you give me can weigh anything, but your per box cannot weigh more than 700 kg.
Okay, sure. And usually, what is the weight range wherein we get most of our like products that we need to transfer?
So we will slowly reveal more and more information to you guys. Give us some time.
Sure. All right. Thank you so much, and really appreciate you disclosing these service parameters. Really appreciate it. Thank you so much.
Thank you. Before we take the next question, I'd like to remind participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Jigar Shah from AK Securities. Please go ahead.
Yes, sir. So I have a couple of questions. So the first one is, sir, just wanted to understand how do we plan on improving the margins to reach the targeted 10 to 12%? And will it be a combination of increased volumes and cost-cutting measures?
So, of course, it has to be a combination of both. But in our case, I believe increase in volumes at this stage is more important than cost-cutting measures. For us, increased volume also optimizes our cost, because our direct cost, which is trucking cost, is a matrix called capacity utilization. And as your volume goes up, your capacity utilization of your trucks also increases, and therefore your cost per kg that you move in a truck reduces. So as Gati stands today, for us to reach that 10-12% EBITDA margin, we have to increase our volumes. That is the most important.
Got it. And so my next question is, I just wanted to an outlook for the coming quarter, provided it being a festive season. So are we seeing a higher demand?
So definitely, as you know, in the express industry, the quarter 2 end and quarter 3 beginning are the best months. And of course, what happens is that customers start creating inventory for sale. So yes, we will see we already are seeing a higher demand.
Sure. Thank you, sir.
Thank you. Reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Rushabh from RBSA Investment. Please go ahead.
Yeah, hi sir, thank you for the opportunity. I just want to understand, sir, in terms of say Surflex Express industry per se growth rate, is it growing in line with our expectation, or is it slowed down a bit, say from 10 to 12% to say low high single digit? Are we seeing any headwinds in this sector? I mean, Surface Express industry per se.
So to answer your first part of your questions, I don't see it slow down below 10 to 12% for sure, the industry growth rate. Are we seeing any headwinds? I think we saw headwinds in the first couple of months of this financial year, but now we are seeing consumption patterns go up and therefore demand increasing.
Okay. The second thing, you mentioned that we are seeing synergies with all cargo. We added new customers. Can you please more elaborate, what kind of new customers are we adding? If you could, what synergies are we exactly, looking for? Please elaborate on this.
So as you know, as a group, today all cargo can offer end-to-end services to any customer in India, which means if a customer wants to import its raw materials from anywhere in the world, all cargo can bring the raw materials either by ocean freight or air freight. Then we also have container freight stations where we can stage the containers before they get custom cleared, post which we can warehouse their material for them nearer to the port or inland. This is a company called All Cargo Supply Chain, which is the contract logistics company. And finally, we can distribute through Gati their last mile deliveries. So this is what we call end-to-end integrated service that we as a group can provide to the customers. Now, if there are customers who are doing import of materials with all cargo, then we can go to those customers and tell them that, hey guys, we can do your warehousing through all cargo supply chain and we can do your distribution through Gati. And vice versa, our Gati customers also, we can tell them that, by the way, if you have any imports or exports, or if you need any warehousing, we can do that for you. And that is the advantage of the cross-sell that we have now constituted in a group as a process, and it is monitored at the corporate level of the group. The advantage that one sees is that if there is a warehousing customer with all cargo supply chain, and if Gati is not distributing from that warehouse, then we can go visit the customer together. And because of the good relationship that is existing with all cargo supply chain, Gati could start doing distribution from that warehouse. So this is the kind of synergies that we are looking at for all the services that the group can provide.
So I just wanted to understand. So how much of the synergies, that we are actually tapping right now? Have we started recently? I just want to understand on what stage of leveraging those synergies are we as Gati currently in?
So it is a continuous process. Every month there are a couple of customers that we get leads, and then we of course have our conversion of those leads taking place. It is a very structured program that is run in the organization, and yes, we are seeing initial wins from this program for Gati and from Gati also.
Okay. Just the last question. So recently we hired Mr. Rajesh, who has had a very good background. So in terms of, adding more people at this level, are we looking to add more people, or we are done with, adding more people in the second execution team stage?
So we have also... So we keep identifying the gaps that are required by Gati, and we fulfill them. We have got Rajesh now. We also very soon will declare a digital marketing gentleman that we have just recruited. It will be out in the press very soon. We believe that a combination of digital marketing and good pedigree sales will really get us our volume also going.
So there's significant front-loading in employee cost for us currently?
Not necessarily, because these, for example, Rajesh has replaced our chief commercial officer who who will be leaving the organization soon.
Okay. Okay. Thank you so much.
Thank you. Before we take the next question, a reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Praveen Sehai from Prabhudas Lilladher. Please go ahead.
Yeah, thank you for that. So my question is related to the Surface Express business. And in the last 5 quarters, if I look at on the volume, is in the range of around 280 to 282,000, or this quarter is almost as 290,000 tons. So can you give some color, like after creation of these hubs, super hubs, how much it can go, or any parameter like on the utilization side of those things to track on the way forward, how this number to move actually?
So this is a way of asking me what is my revenue going to be in the next quarter, right?
No, not exactly, sir, because just trying to understand that's all the improvement we had done, a lot of improvement we had done. So these numbers, how to move on? Because QOQ, if I look at, it's almost a flat, like for 5 quarters, it's a 1% or 2% up, and then so just trying to understand. Yeah.
Let me tell you all. So it's been some time that we now have acquired Gati by All Cargo, right?
Mm-hmm.
We have been for the last 2 years doing a lot of work in Gati to make Gati great again. Okay. Once the confidence comes into the management starts putting numbers out there. So you must have now noticed that for the last 2 months, we've been putting our volume numbers out, right? You saw that in the month of June. You'll see that in the month of July. You see that in the month of August, right? And that will give you the answer to your question as to how volumes are moving. Secondly, we have also now put out service parameters. And the fact that a management puts out volumes and service parameters should tell you that the management is now confident of what it has done over the past 2 years, and therefore it is putting its neck out and giving you these parameters out in the open. So I would just suggest that follow us every month and you'll get to know the volume increase.
Okay, great, sir. Great. So second, sir, on the client mix, as that's a client mix has been given like of some 60% or MSME has a 20%. So is there any margin differential in those different kind of a client mix? And this mix, what the presentation has given, it is of a revenue or is it of volume?
Revenue. So,
and if you can give the volume as well.
I have said this before also, that the large customers, whatever we get as a yield from them, the yield for the MSME customers is 40% more than that, and the yield for the retail customers is another 40-50% more than that. So that is how the business works between the large customers, the MSME and the retail. With regard to the volume customer-wise, give us some time. We will start putting out some more details also to you all. We want to be as transparent as possible with all of you. Okay?
Sure, sir, sure. Just a last question on the, the Bangalore hub, which you are starting from this month onwards. So, is it a similar line of Faruk Nagar or the Bhiwandi? Is it as big of that?
Absolutely similar.
And is it also a consolidation of some hubs there you are doing, like of Bhiwandi you have done?
Yes, two hubs in Bangalore which are getting consolidated with a much larger space that we are setting up in Bangalore. just for all of y'all, Bangalore is one of our largest delivery cities in the country.
Okay, that's it from my side, sir.
Thank you.
Thank you.
Thank you. The next question is from the line of Gati Desai from Turtle Capital. Please go ahead.
Hi, good afternoon, Phil. So my first question is, we have been talking about the legacy issue, and because of that, the discounting we have to do. So is it likely to be over in this quarter? And had it not been the case, what would have been our gross margin this quarter?
Good question. So I would only put my neck out and say that a lot of those issues have now finally reduced. I am not saying they are over, okay, but they have reduced dramatically. It's only a matter of, I would say, another quarter or so before I can come back and say now it is BAU. How much impact that has on the margin is not something that I would like to talk about over here.
Okay. The only reason I'm perfectly okay if you're not willing to share the detail. The question is that because we have operationalized a lot of new hubs and there's some time which has passed, and you mentioned about increased productivity, etc. And our goal was always 30-31% and eventually reached to 32% gross margin. So on that journey, had it not been the case, we are at a comfortable place where you would have thought that we should be, given all the efforts that we put in.
In a way, yes.
Or you think that there is still some distance to cover?
No, so our operational efficiency continues constantly, but we have reached a very good stage in operation.
Okay. And second question, Phil, is on this contract logistics business. We talked about a lot of synergies, and we have done that in the past also. And there was also some talk about the restructuring within All Cargo Group. So, any sense on whether that business is going to be merged, or if so, what is the timeline for taking the decision? What are the parameters? Some light on that would be very useful.
So I thought you analysts were smart people, yeah. You all already have been told that I'm the MD of All Cargo Supply Chain, now the MD of Gati, right?
So that is the genesis from where this question started.
So एक step तो हो गया है. अभी wait for some time. We will let you all know there is a restructuring happening. We'll let you all know.
Okay, got it.
Thank you.
I'm sorry, but I have something come up. I have to leave now. I'm very sorry. So if there is the last question maybe, or if you, Anish can continue.
Sure, sir. We proceed to the next question from the line of...
So I will log out. Thank you very much, everyone, and sorry about this. Something urgent has come. Yeah.
Thank you, sir.
Thank you.
We proceed to the next question from the line of Krupa Shankar from Avendus Spark. Please go ahead.
Hi, and thank you for the opportunity. One question from my side is on the general pricing environment in the industry. Just wanted to assess if it is holding on, or are you seeing more aggressive players coming in? Because you have seen a recent string of announcements wherein which pricing is looking very dilutive in nature. So just wanted to get some thoughts on that.
Yeah, I would say the environment is now competitive with all the players kind of very aggressive in the market. So, from that perspective, we also kind of, make sure, we don't dilute so much, but at the same time, we drive the volume. I think that's the whole, game all about. So our focus is to kind of, get the volume at the same time, not to dilute too much, but there is a competition aggressive competition, in this industry.
Mr. Krupashankar, we are unable to hear you well. If you have a question, you may please go ahead.
Hello.
Mr. Krupashankar sir, we've just lost the line for the last participant. Well, ladies and gentlemen, that was the last question for today. I would now like to hand the conference back to the management for their closing remarks. Thank you, and over to you, sir.
So thank you, everyone, for attending this call. If you have any more questions, you can either, mail our IR team, for, any kind of response which is required for any queries.
Thank you very much.
Thank you very much.
On behalf of Prabhudas Lilladher, we conclude today's conference. Thank you all for joining. You may now disconnect your lines.